Unit 11. Insurance. Key words: compensation, disaster, protection, coverage, policy, sue, compulsory, premium, deductible, disability, beneficiary, pension. Insurance.
The purpose of insurance is to provide financial compensation to people and organizations when something unexpected or disastrous happens, and the result is financial loss. In a way, insurance companies offer protection so that an accident, a severe health problem, a fire, or a natural disaster such as a flood will not result in a financial disaster to a family or business entity. The first form of insurance coverage was marine insurance, provided by Lloyd's of London in 1689 to protect ship owners and merchants from loss if a ship sank with its cargo. Nowadays, many different kinds of policies are offered. Policyholders commonly insure their health, their property, especially homes and autos, and their lives. And they also carry liability protection. Liability insurance protects the policyholder against a legal suit in which somebody may sue the policyholder, claiming that the policyholder was responsible for damage that the plaintiff, the person who sues, suffered. For families, it is important, of course, to protect their major investments, and so they insure their homes against fire and the family car against damage from accidents. In recent years, automobile insurance, especially liability protection, has become very expensive, and in many places it is compulsory, which means the family members cannot use the car if they do not have insurance. For some families in the United States, especially those with teenage drivers, the premiums may be well over $1,000 a year. Health insurance is also very important to the family because the cost of health care has become very high. One way in which the cost of the premiums can be reduced is to carry a high deductible amount. This means that the family would pay for the first $500, for example, of the costs, and the insurance company would then pay for the rest, after the first $500 has been deducted. A form of health insurance called disability insurance is also carried by many working people. If they are disabled and cannot work, perhaps because of a broken arm, they will receive money from the insurance company. Life insurance is paid when a person dies. The beneficiaries of the policy will receive money to cover the lost wages that the dead person can no longer earn. This kind of protection is especially important for families with small children, where it may be difficult for the surviving parent to work and care for the children. Another kind of insurance provides the financial security a person needs when they retire and no longer earn wages or a salary. Most people, while they are working, belong to a retirement plan, and then when they retire, they receive a pension. In the United States, there is a compulsory retirement and health insurance plan called Social Security and Medicare. For many older people, the arrival of their monthly pension check is a very important event, even though it is barely enough to meet everyday expenses.